Ladies and gentlemen, welcome to an intraday update on AMC Stock, and can't you believe it? AMC is in the green today by over 1%. GME as well is actually recovering from their earnings catastrophe. And we have a dire warning from JP Morgan. This guy, his name is Bob Mitchell. He manages $700 billion of bonds for JP Morgan. Now, he says that essentially what you're seeing right now is similar to the deceptive lull during the 2008 financial crisis. That period, he says, from March to June, where markets in 2008, seeing JP Morgan come out and bail out some of the smaller banks that were failing, and all things were fine and dandy, like Bear Stearns. And then eventually, Lehman Brothers went down September 15th, and all hell broke loose. We need to get into this situation, how this could affect AMC stock, as well as where AMC stock currently is as far as the data is concerned. So let's get into it, guys. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. So let's get into it first things first with what we just mentioned. JP Morgan's bond chief, Bob Mitchell, sees worrying echoes of 2008 in the market calm. Now, if we look at exactly what he says here, so he says, quote, "This does remind me an awful lot of the March to June period in 2008, where Mitchell rattled off the parallels. Then, as now, investors were concerned about the stability of U.S. banks. In both cases, Mitchell's employer calmed frayed nerves by swooping in to acquire a troubled competitor. Last month, JP Morgan bought failed regional bank player First Republic in March 2008. JP Morgan took over the investment bank Bear Stearns. Quote, the markets viewed it as there was a crisis. There was a policy response, and the crisis is solved," he said. But then you had a steady 3-month rally in equity markets. The end to a nearly 15-year period of cheap money and low interest rates around the world has vexed investors and market observers alike. Top Wall Street executives, including Mitchell's boss Jamie Dimon, have raised concerns over the economy for more than a year. Higher rates, the reversal of the Federal Reserve's bond buying programs, and overseas strife made for a potentially dangerous combination, Diamonds and others have said. But the American economy has remained surprisingly resilient as May payroll figures surged more than expected, and rising stocks caused some of the so-called start of a fresh new bull market. The cross-currents have divided the investing world into roughly two camps: those who see a soft landing for the world's biggest economy, and those who envision something far worse. And the calm before the storm. Goes on to say, the signs are clear. The next few months are merely a calm before the storm. Mitchell oversees more than $700 billion in assets for JP Morgan and is also global head of fixed income for the bank's asset management arm. In previous rate hike cycles, going back to 1980, the recessions start on average of 13 months after the Fed's final rate increase, he said. The central bank's most recent move happened in May. And this is a chart of from the last policy move from the Fed to when you ultimately went into a recession. Now it says, quote, in that ambiguous period just after the Fed has finished raising rates, you're not in a recession. It looks like a soft landing because the economy is still growing, Mitchell said. But it would be a miracle if this ended without a recession, he added. The economy will probably tip into a recession by the end of this year, Mitchell said, while the downturn start could get pushed back thanks to lingering effects of COVID stimulus funds. He said the destination is clear. Quote, I'm highly confident that we're going to be in a recession a year from now, he said. Now, it goes on to talk about a couple things as well. They do expect that some of the greatest pain will be in regional banks, commercial real estate, and junk-rated corporate borrowers. This is something that Deutsche Bank also said as well, that your junk bonds are likely to hit default rates over 10%. And he goes on to say that there are a lot of things that resonate with 2008, including overvalued real estate, he said. Yet, until it happened, it was largely dismissed. And it makes a lot of sense, okay? Me personally, I think you don't get the recession, you don't get economic activity slowing down and real pain in the economy and the stock market until July to August, or maybe even September, maybe even towards the end of this year, maybe the holiday season. Largely because of student loan repayments. The average student loan repayment is around $250 per person per month. Well, borrowers over $40,000 of student loan debt, which is over 50% of borrowers, those average payments are over $500 a piece. So even if you refinance that, you're still going to be paying a lot of money per month. And I think that's where a lot of this extra spending has been at in the economy, has really been because of the not needing to pay student loans. Whereas every other year that the Fed has been raising rates and you've seen kind of a rate hike cycle, you've had that kind of liquidity being drained out of people's bank accounts on a week by week, month by month basis. So I think there is definitely merit to be had there. Now, in the short term, we're going to have the CPI report coming out next week. We'll talk about that a little bit more in the next video. CPI will be coming out on Tuesday. Fed Jerome Powell will be on Wednesday. Those are going to be the biggest catalysts that will drive this market over the next couple of weeks. Markets right now are expecting the Fed to pause their interest rate hike cycle June 14th. Now, it all depends what CPI does, because if CPI comes in hotter than expectations, the Fed's probably not going to pause. If inflation comes in lower than expectations, you're definitely going to get a Fed pause. But markets are still expecting another rate hike in July. And then after that, you're expecting a pause in September, and then you're expecting a rate cut by November. That's insane expectations for Fed policy. So I think something is clearly wrong here, and I think equity markets have to come down from the levels that they are at, just given what we're currently faced with. I mean, it's not at all, a good situation that we have right now. As if inflation continues to come down, that's your most bullish outcome here, but signs recently not really suggestive of that. So I think stocks have to come down. I think that does put pressure on shorts and their liquidity situation if you give it a little bit of time. Now with AMC stock, the biggest catalyst around the corner is going to be the court date on June 29th. But from here, I think you have priced in a lot of that pain from the court, this upcoming court date, if it is a negative catalyst, based off of this fall that we have seen since the beginning of May to where we are now. AMC stock from then has fallen from $6 per share to $4.73, a drop of 22.5%. Even back here, the last time we reacted to the courts was on April 4th, and AMC stock dropped 23.5%. Similar move to what we have already fallen, right? So that makes me a little bit more bullish, just knowing a lot of the price decline that you'll likely see from the courts is already priced in. Now, if we look at what's actually happening on the day today with AMC as well as GME, there's no news. Like, this is not a news-driven move. This is simply an oversold bounce, in my personal opinion. If we take a look at the Ortex data, go ahead to the shorts. You have a short score of 93. $528.17 million worth of short interest, estimated short interest of free float at 21.86%, free float out on loan at 36.09%, shares out on loan 186.37 million, days to cover 7.87, cost to borrow 68.14, and 100% share utilization. The days to cover going higher like we are seeing now is the most bullish thing that I can sit here and tell you guys. that is what's going to really get shorts to cover on their short positions, to get squeezed out of their short positions, and to drive AMC stock much higher from here. Now, the live short interest of free float is sitting at about 22%, 113.37 million shares currently sold short. We know there's a lot more short interest, but it is held in the option activity, right? We know this. Cost to bar max, 311%. Cost to bar minimum, 15.13%. Interactive Brokers short availability has 0 shares currently available to be lent out. Last we knew, cost to borrow fees were around 65%. Take a look at the option activity for the day. Well, no surprise, you're seeing some of those $10 puts being placed on AMC stock. 2 of these orders worth almost $200,000. One of them for June 16th, the other one for July 21st. So, all in all, it's a green day, but it's going to be volatile in the markets. And I do expect from here AMC has priced in a lot of that bad news. Could make sense to go long here with some options over the next couple of months. Could make sense to buy the stock here. And that's personally what I'm doing, but I'm not a financial advisor, not a financial planner. Come to your own conclusions. Let me know what you guys think about this information down below in the comment section. Nonetheless, thank you for watching, and I will see you in the next one.